Good afternoon, everyone. School of Postgraduate Studies and Department of Agricultural Economics cards cordially invite you for the endowment lecture on policy issues in Indian agriculture. Now, I call upon Dr. N. Sendil, Dean, School of Postgraduate Studies, to deliver the welcome address.
So, good evening to all. Today's guest speaker, Professor RAMAKUMAR. So, the head of the Department of Economics, Dr. Senthilnathan, the director, COTS, Dr. Suresh Kumar, and the online participants, especially our former Vice Chancellor, Dr. C. Ramasamy, and the known economist, and the students, both masters and doctoral program. I really welcome you all for this today's endowment lecture. We all know that Tamil Nadu Agriculture University is organizing series of endowment lectures and by the eminent speakers. So today's is the one of the great day where one of our alumni of TNAU, he's come over here and going to talk to you after. Yeah, I welcome Dr. Ram Kumar. So it's a very great, it's a very memorable occasion where our one of the alumni grow in longer heights and working in a long period in Indian Social Science Institute, Tata Institute of Social Science, Mumbai, and published recently the great book on Indian policy issues. And he's here to talk to you about the various policy issues related to Indian agriculture. You all know that Indian agriculture have a lot of transformation every decade. So this decade is a different one. I need not explain the things because the great economists are here. So he's going to tell about the what are the policies. The our vice chancellor is keen in interdisciplinary research. People from different walks of life talking on different areas in this endowment lecture series. So in such we have talking science, we can talking on policy issues. So a lot of issues being talk in this endowment lecture series. So in this series, the very key component is the policy issues, how the Indian agriculture change. Unless the policies are proper, the research or the investment on agriculture or the research focus will definitely will have great impact. So in this, really your presence here today definitely will great impact on the other, not only the social scientists, so people working on different sciences will have the knowledge on how the changes is actually happening in the different decade on Indian policies on agriculture. So this will help us to redesign our research objectives or focus on the research, some of the areas which have key on the development issues. Those things will definitely will help us. So your lecture definitely will benefit all the faculties and student community of Tamil Nadu Agriculture University. On behalf of our Vice Chancellor, Tamil Nadu Agriculture University, I welcome you for this today's evening lecture and welcome you on behalf of Dean PG Studies and all students. And I also really thank the Directorate of Courts and Economics for arranging this, the eminent speaker for making his here presence today. So thank you one and all for giving me the opportunity. Thank you.
Good afternoon, everyone. Our most respected and most beloved former Vice Chancellor, Dr. C. Ramasamy sir. Today is the guest speaker, Dr. RAMAKUMAR, the Dean School of PG Studies, Dr. Sendil, my friend Dr. Suresh, who is online, the head of the department, and Dr. Senthilnathan, colleagues in the courts and students from Agricultural Economics Extension and Management. I also join hands with Dr. Sendil PG Dean to welcome you all for this PG endowment lecture. Actually, today is a special day for all of us when we have one of the leading economists, leading development economists in the country. And proudly, we say that he is alumnus of the Department of Agricultural Economics. So when we approached him to deliver an endowment lecture here, so immediately he has accepted, and really we are very much thankful to Dr. Ramkumar for accepting our invitation and to be here to deliver the endowment lecture. So as indicated by our Dean, School of PG Studies, Dr. Ramkumar is actually alumnus of our TNAU course, the Department of Physical Economics. He has actually completed his bachelor's in agriculture from Kerala Agriculture University and master's in agricultural economics from the Department of Physical Economics, TNA Coimbatore. And he has done his PhD in quantitative economics from Indian Statistical Institute, Kolkata. So ISI Kolkata is one of the premier institutes, one of the oldest ISIs in the country. This is the first ISI in the country where the ISI produced a lot of eminent economists and eminent statisticians. Okay, and so after his, so the studies that he he has been working in different institutes in the different cadres, and he assumed very eminent and very prestigious professional positions. So I just there is actually a very long list. Just for the time being, I would like to restrict myself and indicate very few. Currently, Dr. Ramkumar is a professor the School of Development Studies, Tata Institute of Social Sciences, Mumbai. He is also, the member, State Planning Board, Government of Kerala, from 2016 until date. And he's actually assuming the position of chair in political economy in the Goa University, and distinguished visiting scholar in the School of Business Management, Queen Mary University of London, for 1 year. And then he also assumed some of the critical positions like the Dean School of Development Studies, Tata Institute of Social Sciences for 2 years. And he had actually one of the I request all the online participants to kindly mute your speaker. And Dr. Ramakumar actually he actually secured the NABARD chair, one of the prestigious position from the National Bank for Agriculture and Rural Development. Just he completed. It's a 5 years project. So NABARD chair is securing NABARD chair is a very prestigious, and it's a very professional one. So he has done that, and he is also the visiting research fellow in University of Zurich during 2016. And I have a very long list, so just I restrict. Please pardon me, excuse me, Ramakumar, for restricting myself to limit very few. Okay, and to his actually professional in the field of professional, he contributed significantly by way of writings. He's actually so the Hindu business line, frequently you can see his writings. Okay, and during the COVID time also, very frequently you can see his writings on the different developmental issues of the country. So far, he published 2 papers and published more than 75 papers in various national and international journals of repute. And very recently, he has released a edited book on distress in the fields. That is actually that received attention from the policymakers of the different states and of course the national level. So I'm very glad that glad to have you here, Dr. Ramakumar. Okay, and we all very keen to listen to your talk on the policy issues in the Indian agriculture. Okay, so with these few words, I once again, I join hands with Dr. Sendil, PG Dean, to welcome Dr. Ramakumar uh, to this endowment lecture. Okay. Yeah. Thank you so much.
Now, I would request Dr. R. Ramkumar, Professor, Center for Study of Developing Economics, School of Development Studies, Tata Institute of Social Sciences, Mumbai, to deliver the endowment lecture.
Thank you. Good afternoon, everyone. Dr. Senthil, Dr. Suresh Kumar, Dr. Senthil Nathan, faculty at the Department of Agricultural Economics and other departments under CARDS and the university. Dr. C. Ramasamy, who is here online. Thank you very much for inviting me to deliver this endowment lecture. The first paragraph of the lecture I'll read out, and then I will move into my PowerPoint because I've written it very carefully. So it's a great privilege to be invited to give the endowment lecture at the Department of Agricultural Economics at TNAU. This department is one of the best departments of agricultural economics in India with a glorious tradition. And I've been fortunate to have been its former student of the master's program between 1996 and 1998. I fondly remember the fantastic teachers we had in those years. Dr. C. Ramasamy, who later became the Vice Chancellor of TNAU and who was a source of constant encouragement even after I left the campus. And today morning, when I told him that I'm here, he was very happy to tell me that I'll be joining you online. And I'm greatly thankful to him for having joined, even though he's traveling and he's not feeling very well. Then Dr. K. Palanisamy, who headed the Water Technology Center in those days, a rather fearsome man. We were all very scared of him, who welcomed us very warmly, however, into the world of econometrics. I remember Dr. Palanisamy began his econometrics class from backwards. He first ran a regression, and then he gave us a printout of the dot matrix printout of the result, and then he started asking us to interpret it. That's how you'd start his econometrics class. I learned enormously from that way of teaching econometrics, and I'll remain grateful to him for that. Dr. S.R. Subramaniam, another rather fearsome person who taught us macroeconomics and who was famous for closing the door of the classroom as soon as he entered the classroom. And even if there was a student walking right behind him into the classroom, he wouldn't allow that student to come. It's just great fun because that means morning. It was a sprint from the hostel to the classroom because he used to take the 8 a.m. class. So that means you have to be in the class by 7:59. He would enter at 8, and if you're 1 second behind him, you're out. So that taught us a lot about discipline. Let me say. Then Dr. Sundaresan, S. Sundaresan, who was a very kind soul, who was my dissertation supervisor, from whom we learned research methodology. He first told us in the first class, research is research. That's how he began his class. And so everything is a research. You're not finding anything gloriously new or anything. All research is repeat. So just remember that, he said. Dr. Ajjan, he was a planter himself and who taught us enormously about agricultural marketing in those days. I remember him also very fondly, and many others, Dr. Nasruddin, Dr. Balasubramaniam, and so many others who were there with us during that time. It was due to the rigorous training that we received here that I was inspired to pursue a PhD in economics later. And I continue to work in agricultural economics, and I hold the lessons I learned here close to my chest even today. So I'm greatly thankful to the department for having invited me to give this endowment lecture. So let me begin my lecture. So basically, I was asked to speak about policy issues in Indian agriculture, and I've taken the little liberty to add a subtitle to it, which is illustrations from a heterodox perspective. What I intend to do in this presentation is largely following the book that I just mentioned about, which came out in end 2022, where some of these ideas are discussed in a very long introductory chapter as well as in other chapters. And basically, I plan to structure my presentation in the following way. I shall begin with some general empirical trends in Indian agriculture. And that's going to be the background from which I'm going to, in which I'm going to place my arguments. Because of shortage of time, I'm basically going to stick to 2 policy issues and 3 conceptual issues in this presentation, because the book has a longer discussion, but I'm sorry that I will not have time to speak about more within the time that I have. But the main question that I want to pose is the following. Most of the textbooks that we study, most of the mainstream literature that we refer to have one view of agricultural economics. They tend to teach us to learn and practice agricultural economics in a particular way. I call that the orthodox view. Now, the argument in my presentation here is going to be that much of the arguments from that mainstream schools of thought have failed us, are not conceptually valid in many ways. We somehow tend to learn them uncritically, but I think there is a need to look at those arguments much more critically. In other words, I would like to say that we need to take heterodox views of agricultural economics more seriously when we look at both research and teaching in agricultural economics. That's going to be my broad argument. I have no claim that I'm going to clinch the matter in this presentation, but I do wish to place a few dissenting views in front of you, and if that sort of generates some amount of discussion, that would be good enough for me as far as this lecture is concerned. So this is going to be the broad structure of my presentation. Let me begin, friends, with some numbers. The key point in this table, which is actually a long from independence right up to the pre-COVID period, that is 2019-20. I'm not going to speak about COVID today, so I'm going to stop at 2019-20 because COVID is a very separate story altogether. And that's going to complicate our discussion. So I'm going to stick to 2019-20 as the end year. What this table tells us is that growth rates in agriculture have generally slowed down in the last 30 years compared to the period prior to that. If you take the 1980s and then you compare it with 90s, 2000s, and 2010s as an average, you will see the growth rates in agriculture have slowed down. I will invite your attention. These are primarily compound growth rates of index numbers of, I've kept area out because area we've reached stagnation in so many ways, production and productivity. And if you look at the last row for all crops, you will see that the growth rates of agricultural production were about 3.4% per year, averaging in the 1980s, 1981-82 to 1991-92. And you will see that they slowed down in the long period of 30 years to 2.2%. So in the last 30 years or so, 3 decades of economic liberalization, as we call it, growth rates in agriculture have not enormously picked up. In fact, my next table would clarify things a little further about these 30 years, because 30 years is a long period. I'm comparing it with 10 years prior to that. But I'm going to come to that. But the long story is certainly not inspiring. It's only about 2.2% per year. If you look at food grains, the fall of production is rather, production growth rates is significant. From 2.9%, you will see food grain output slowing down to 1.9% per year. Cereals 3.2% to 1.8%. Rice has a significant shortfall in growth rates, 4.1% to 1.6%. You'll see, but there are some crops which have grown. You will see that pulses show a slight pickup in the last 30 years. But oil seeds, if you see again, it's an adverse story out there. Similar are the trends in productivity also. You will see productivity growth is also slowing down in the last 30 years compared to the 1980s. This is the long story of liberalization. So you do not see agricultural growth rates picking up significantly during this long period. But it's a long period, so we need to cut it to 3 shorter periods. That's going to be a better way of looking at the problem. Now, this is that story divided into 3 decades: 1990s, 2000s and 2010s, broadly the 3 decades of these 30 years, you will see that out of these 3 decades, the first and the third decades saw a very poor growth rate in agriculture, whereas the second period saw some pickup of growth rate in agriculture. So the 90s are a bad decade. The 2000s, you see a pickup, but then in 2010s, you see growth rate falling again. That's the larger story of these 30 years. You will see that food grain output, you'll see it was just 0.6% in the 90s, rose up to 2.5% in the 2000s. By 2000s, I mean 2003, 4 to 2010, 11, but then fell again to 2.2% in the 2010s. You will see for all crops that is more prominent from 0.6 to 3.1 to 1.8. That's the growth rates that you see for these 30 years. Similar are the trends in productivity. Overall productivity growth was 0.3% in the 90s, rose to 3.3%, and fell again to 1.3% in the 2010s. So essentially, you do not see any sustained pickup of growth rates in agriculture in these 30 years. You see this pickup between 2003, 4 and 2010, 11, largely because of global conditions. Global agricultural prices were ruling very high in this period. You saw exports growing from India. Higher prices meant that domestic prices also picked up, so farmers received a better price. Public investment in agriculture increased a little bit. Rural economic activities improved because of the introduction of the Mahatma Gandhi Rural Employment Guarantee Program and so on. So there was some rural economic momentum that picked up in the 2000s, but which was not sustained into the 2010s because global agricultural prices began to fall again after the global financial crisis, particularly after 2010, and that triggered another period of slow growth in agriculture. So the premise that I want to begin from is the following. The period of economic liberalization has seen occasional spurts of growth, but it has not seen any sustained growth of agriculture, either in production or in productivity. This is not to say that some crops have not performed well. Maize has performed well in this period. Pulses have performed well. Fruits and vegetables began to perform well, but they did not perform well in the last 10 years. So there are crop-wise variations for sure, but the overall story, if you keep food grains at the center of it, is not a very rosy story that you see for the last 30 years. Now, this is, I had used data on index numbers of production and yield in this slide. And even if I use data from the National Account Statistics, which is value of production from the National Account Statistics, I get broadly the same number. Cereals, you will see from 3% in the 80s falls to 1.5% in the 30 years. You get a broadly similar trend if you look at value of production also. I just gave this slide here because I didn't want anyone to say, if you use this, you would get a different result. No, you don't. You get very similar results here as well. Now, this has also reflected in the incomes that rural households earn. Now, the situation assessment survey, which is conducted by the National Sample Survey Organization, if you look at the last two rounds of it, in 2012-13 and 2018-19, you will see a very particular trend of household income growth in agriculture. This is household income from agriculture. In nominal terms, you will see the income from cultivation appears to have increased between 12-13 and 18-19 by 23.3%. But if we deflate it, because that's what economists are interested in, if you look at it in real terms, you will see real incomes from cultivation fell by minus 1.4%. Right? Now remember, you keep hearing claims about doubling agricultural incomes, farmers' incomes between 2015 and 2022. But essentially, what you see in this, it's not covering the full period. Another round of SAS is happening, so you will know better results then. But these numbers between 12-13 and 18-19 do not show any rise of agricultural incomes. In fact, it shows a fall in the absolute real incomes in agriculture in this period. What has increased are actually wages. If you see wages, real income from wages of agricultural households are rising by 57% in this period. So in fact, it actually shows that agricultural households are earning more from wages, that is hiring out their labor out to others rather than by from selling their crops. So that is a very interesting trend. Some people have calling it proletarianization of agricultural households and so on, but that's another debate. Let's not enter there. Numbers actually show what you're seeing on the screen. So this is also in line with the overall numbers that I showed in the previous slides, particularly in the last 10 years, 2011-12 onwards, growth rates have been very low, and that's reflecting in these numbers of household incomes also. Now, one more slide I'll show you, which essentially will say the same story. These are essentially numbers which are ratios. These are ratios of the rupee value of agricultural exports to rupee value of agricultural imports. Export value by import value. If exports are growing more than imports, this graph should go up. If imports are growing more than exports, this graph will go down. Essentially, you see that graph is coming down. Essentially, the story is that exports rose in this period by about 13%, but imports rose by about 21%. That's why you see an adverse trend like this. So you have not quite seen an export-oriented agricultural growth path as well, because imports, particularly after the post-WTO period, have grown enormously into India. There's much debate on dumping of agricultural goods, etc. That's a different debate, but I'm not getting there. But this is the story on agricultural trade. This is the context in which I'm going to approach the questions that I asked. What were the possible arguments raised in favor of economic liberalization in agriculture? What were the conceptual points raised? Then let's examine those claims both from a conceptual point of view and from an empirical point of view. That is what I'm trying to do in the remaining part of the lecture. Now, what was the advocacy for liberalization in the 1990s? If you look at the literature during that time, in fact, I was a student here when that debate was going on. So much of what you will see in this slide and next slide are including things that I learned here. The argument for liberalization was largely based by a set of economists on a very prominent role given to the idea of terms of trade. The argument here was that if you look at the agricultural policy in India from 1960s onwards, these policies were such that they skewed the terms of trade against agriculture. You will actually tend to think that no, that's not possible because there were a lot of support measures for agriculture from the 1960s onwards. How can you say that terms of trade was skewed against agriculture? But in fact, the argument is precisely that terms of trade was skewed against agriculture. You understand terms of trade, which is literally the ratio of agricultural prices to industrial prices. You can call it PA by PI if you want. That will be the ratio. Essentially, if this ratio rises, the propensity to invest in agriculture relative to industry will rise, and more investment is supposed to flow into agriculture. That's the purpose of raising terms of trade. Terms of trade falling means in propensity to invest in industry is rising vis-a-vis agriculture. So if the argument is that the propensity to invest in agriculture was lower because terms of trade was skewed against agriculture, how? To begin with, you had a closed industrial policy. The closed industrial policy meant that competition was discouraged in domestic industry, which meant that cost-effective production was not happening in industry, as a result of which industrial prices remained high. That means the denominator was larger than the numerator, which means the terms of trade is falling. Now, the other point was trade policies. You were not allowing trade in agriculture. International prices of agricultural produce are ruling higher at that time compared to domestic prices. So if you actually export Indian products abroad, Indian farmers will get that higher international price compared to the lower domestic price, which means that a lot of models at that time showed that Indian farmers' incomes would be higher by 15 to 25% at that time if they were allowed to export freely into the world. So if you are allowed free trade, Indian farmers would get 15 to 20% more income because international prices are rolling high. and domestic prices are rolling low. That also would shift the terms of, because exports were disallowed, you had a closed protectionist regime. Terms of trade was again skewed against agriculture because Indian farmer had to be content with a lower domestic price and was denied a higher international price. That's the second point. Then came an overvalued exchange rate. The exchange rate was kept overvalued. If you allow the exchange rate to depreciate, then you will find that exports are encouraged and imports are discouraged, which would mean that export-oriented path will improve the terms of trade, particularly in the context of higher international agricultural prices. This was in essence the argument related to terms of trade. So the point was that you need to get the prices right. This was a catchword of that time. Get the prices right. How do you get the prices right? By aligning domestic prices with international prices. If you align the international prices with domestic prices, then you got agricultural prices right, which will improve terms of trade, increase the investment propensity in agriculture, and lead to higher agricultural growth. This was the primary theoretical argument in favor of liberalization in the 90s. You will see this in the World Development Report in 1986. You will see in the World Bank's country memorandum to India in 1991. All these arguments are very clearly laid out in those reports. The second point was free trade. That's the time when the Dunkel draft was being discussed. The GATT agreement was signed in 94, came into operation in 1995. So openness to agricultural trade. Here the argument was, and this was very prominent at that time, that Indian agriculture is net taxed. One would tend to think that a lot of subsidies are there for agriculture. Indian agriculture is likely to be net subsidized. But the argument was, primarily following the OECD literature, that Indian agriculture is not net subsidized, but net taxed. And I'm coming to that in a while. The argument here is that if you liberalize agriculture, net taxation of agriculture would disappear and net subsidization of agriculture would come, just like in European countries. And hence, that would also lead to a higher farmer's income by a certain percentage point. Now, that was the second important argument. The third important argument was related to subsidies, input subsidies in particular, fertilizers, pesticides, or seeds, water, electricity, etc. If you see, the argument was that they were fiscally unsustainable, they were inefficient in terms of its outcomes, and the key point was public investment has been stagnating in India in agriculture for a long time. The reason why public investment in agriculture has been stagnating is because you are spending a lot on input subsidies. If you actually cut input subsidies, then that saving can be diverted into higher public investment in irrigation, rural infrastructure, etc. So there was a counterposing of subsidy and investment. It is because of higher input subsidies that the government is unable to make higher public investment in agriculture. So if you cut input subsidies, it will become possible for the government to raise finances for higher public investment in agriculture, including in irrigation, rural infrastructure, etc. So this was the third important point that came up during that time. Then came finally financial liberalization, where the Narasimham Committee of 1991 was appointed primarily for that purpose. Here, the argument was that just like it was argued that terms of trade was skewed against agriculture in the earlier period, the argument here was that the policy on rural banking after nationalization in 1969 had led to a situation of financial repression in the Indian financial sector. Financial repression is a situation where, because of government control, you actually have lower savings rate and lower investment rate. This was cited as a reason for freeing up interest rates in the banking sector. Interest rates were deregulated and banks were allowed to lend how much ever they want to whichever sector they wanted to. Priority sector guidelines were diluted. The ratio you might have studied in your agricultural finance classrooms, that the post-nationalization period saw an insistence of the government that if you want to open one urban branch, you should compulsorily open 4 rural branches. So there was a 4:1 ratio, which was kept. That 4:1 ratio was disbanded in the early 90s. So all these things were done to allow banks to lend purely on a commercial basis, and not looking at elements of redistribution. if you want to redistribute anything in the economy, it is not the role of the monetary policy. It must be the role of fiscal policy. That was the argument that was raised by the Narasimham Committee. So delink monetary policy from redistribution and end financial repression by liberalizing banking sector, commercializing banking operations, and allowing banks to lend to whoever gives them maximum profit. So this was yet another. I'm going to deal with only these. There are many more, and some of them are dealt with in the book also. But I'm going to deal in this lecture with only these points, and I'm going to examine some of these matters both from a conceptual perspective and an empirical perspective, and sort of consider how robust were these arguments, and how should we, in a long view of liberalization after 30 years, how should we see that debate standing in 2023? That is going to be one way of looking at it. Let me begin the first point, the question of terms of trade. Now, essentially, I said terms of trade is a ratio of industrial prices and agricultural prices, which essentially determines if the terms of trade rises, then you actually see a higher propensity to invest in agriculture relative to industry. Now, terms of trade became important also because if you allow people to export to the international market, they are actually getting higher international prices. This will actually increase investment propensities in agriculture. So this is one way of looking at the policy itself. Now, I'll tell you the primary criticism of this from the heterodox perspective. By heterodox, I mean the schools of thought which will oppose, which will not agree with the orthodox perspective. Heterodox schools is the following. In this particular perspective that you look at terms of trade, you are looking at one singular factor, one singular variable, which is prices. You're basically looking at prices as the determining variable for acreage, for marketing surplus, for marketed surplus, for production, productivity, etc. The argument is that if prices move in a particular way, then farmers' behavior would be such that either there would be higher acreage to that particular crop, or higher production in that particular crop, or higher care and management through family labor, etc., into that particular crop, which will see an increase in acreage and production in that crop. So if you want to raise production of a particular crop, the thing that you should do is to look at prices, is to shift the relative prices in favor of cultivating that crop. That would change the story. So if you want to take out rice from Punjab, for example, if you want to take out rice from Punjab, what you should do is you should reduce the MSP for rice in Punjab. So people will move away from rice. If you want to shift people from one crop to another crop, you essentially need to shift the relative price in favor of that crop to which you want the shift. Right? So essentially, all the discussion in that period was centered around how to move prices, getting prices right. And this led to a large number of changes. Global trade regime changed, domestic marketing regime changed, the MSP regime was not operating in the same way as before. So you will see that if you look at the farmer's perspective, however, price is only just one variable. There are large number of non-price factors which equally, or if not more significantly, affect the production decisions of farmers, which are essentially in the nature of institutions, infrastructure, technology, markets, etc., which were completely ignored by the policies of that time. For example, if you look at terms of trade as a conceptual argument, if the price is moving in a particular direction, can farmers follow that trend? Can farmers follow that relative price change and shift their cropping pattern? Not necessarily, if institutional conditions do not support that kind of a shift. For example, you can have, to give a classic textbook example, you can have tenancy in an area where the landlord may be setting the cropping pattern, or the landlord may be setting the rent, etc. In such cases, any such shift will be constrained by those institutional factors. Similarly, infrastructure. You may not have enough roads or enough rural infrastructure to make that shift possible. You may be able to cultivate it, but you may not find an adequate market for that crop, and hence the farmers may be constrained from moving into one crop to another. Technology, you may have the prices for a particular crop may have risen, but you may not be able to shift to that crop because an appropriate technology, maybe a seed that can be sown in saline conditions or more acidic conditions or any such constrained condition may not be available. So simple price change does not change the story for the farmer. A price change is good. A rise in price is good for the farmer, but a rise in price cannot be considered as the sole determining variable if you want to change the cropping pattern in a country or you want to push the farmer from one crop to another. It's going to be almost impossible to do that. So this conceptual dissonance is very much there in the literature on terms of trade. If you look further from here, if you look at the summary of the literature, essentially you all have studied supply response. Supply response is essentially the elasticity that you see with a price change, how much does output change, or with a price change, how much does acreage change. We would all have studied the Cobb-Webb model and so on in your classrooms. But essentially, if you look at the literature on that, this is the result that you get. The crop-specific area elasticities that you see in the literature are in the range of 0 to 0.8. 0 to 0.8. So in the 0.8 is only for some crops in some conditions. This is the range that you have. In some crops, it is 0. Even if the prices shift by 1 unit, there is absolutely no change in area or production in a range of crops. That's why it's 0 on it. In the long run, the situation changes. Slight improvement. The lower end becomes 0.3, but it's still very low. If you change prices by 1 unit, you are getting output or acreage change by 0.3 only at the lower end. So it's not a very linear story. It's not a very straightforward story when you look at prices or changes in relative prices and what happens to acreage or productivity. The literature shows that the positive effect is confined to a few conditions and a few crops. In many other conditions and many other crops, the situation is not a linear relationship. Why does this divergence happen? There are both technical factors and economic factors. The literature tells you that technical factors there are very specific, very crop-specific yield risks that you will see across crops. You may be able to cultivate, the terms of trade may shift and you may be able to gain benefits from it only if you do multiple cropping, but irrigation may not be available. So multiple cropping may not be feasible. Availability of arable land is always up. If you are looking at acreage as the outcome variable, then you will see that acreage has constraints to expand because much of the acreage has already been cultivated. And then there are economic factors like crop specific price risks. Some crops are very vulnerable to price risks because they may be export oriented and so on. And farmers may be risk averse. They may not shift into some crops. Even if prices rise, farmers may tell you, oh no, I don't want to get into that crop because it's very vulnerable to fluctuations. And I'm happy with a less risky, stable price crop compared to, even though the price may be low, risks are lower, and I may prefer that. It's quite possible that the preferences of many farmers are of that sort. Relative importance of the crop. In India, you will see that rice, wheat, millets, pulses are main crops. And the culture in agriculture is largely rooted in a particular cropping pattern and its cultural values. And it's very difficult to introduce a new crop into the system, which will mean that there'll be a drastic change in the cropping pattern and the way the farmers see agriculture. So that's also another cultural factor which constrains shifts in acreage. Then farm size. If you want to, millets. I was talking to Dr. Senthilnathan in the afternoon. We were talking about the millet mission and so on. If you want to expand millets, fine. But where will millets grow? Where is a new area to cultivate millets going to come from? You don't have any new land to cultivate. So it must either replace an existing crop or it can be an intercrop in existing within the existing cropping pattern. Now, if you want to consider it as an intercrop, what will happen is if you look at large farmers and small farmers, I'm familiar with an example in Maharashtra where we used to do a lot of village studies. People used to grow cotton and tur the pulse in the same field. And the usual thing is that the man in the family wants 1 row of tur after 5 rows of cotton. But the woman in the family wants 3 rows of cotton followed by 3 rows of tur. And there is a big fight during the sowing season between the husband and the wife in the household as to which one would be the practice that they would follow. Why? Because the woman considers food security as more important, but the man is considering more income from cotton as the outcome that they wish. But what the reason for citing this example is that if you are looking at a small farm, then the luxury of intercropping is not available in a small farm, but the luxury of intercropping is available in a large farm. And so there are going to be size-wise differences also in terms of how farmers will shift from one crop to another. So that's yet another constraint. You can change prices in whichever that you want, but all these constraints will play in the opposite direction and kill all the momentum to shift a cropping pattern in a particular direction. Tenancy, I've already spoken about it. And then there are sociological factors, farmers' literacy, etc., to move from one crop to another. These features also play a very important role. The point, in summary, is that specificities of soil, climate, irrigation, etc., govern much of the farmers' decisions. Farmers' decisions are subject to many of these constraints in terms of the specificities of soil, climate, and irrigation. And prices only play a much marginal role in this whole story. You can do whatever you want with prices, but if these features do not change, you will not get the desired result. This is why you have such low elasticities that you see in the first bullet point. The area elasticities are low primarily because the cropping pattern shift is constrained by a lot of non-price factors, and those non-price factors have not been the focus of the liberalization program. Have been here and there, but largely the ideological focus of economic liberalization in agriculture has been focusing on price, relative price, shifting the terms of trade, and that has not succeeded in it. My argument, so the terms of trade argument has to be considered with more than a pinch of salt. That's the point I want to make. There is more. If you want to rub it in a little more, you will see that supply responses in agriculture are different for a range of reasons. We already mentioned land size as being different. There is more. Factor markets are imperfect. The terms of trade argument assumes that if price changes like this, then the farmer will change like this. He won't. That assumption is that if that change has to happen, there has to be a perfect land market, a perfect labor market, a perfect capital market, etc. Do we have any of these? No. So imperfections in factor markets, land, labor, credit, etc., are significantly constraining any shift in farmers' behavior, even if terms of trade shift in favor of agriculture. So to give an example, if credit markets are imperfect, investments are always out of past savings because there is no credit forthcoming, and which means that those who have more savings will be able to invest more. Those who have less savings will be able to invest less. So you do not see a desired outcome at the end of it in the aggregate. Then the other big problem, which is that any relationship between price, if you take marketed surplus as an outcome, sales as an outcome, you will see that there is always a governing level of a trade-off. What is this trade-off? The trade-off is between leisure and income. The trade-off is between own consumption and purchase goods. The trade-off is between income and security. I'll give you a simple example here. Thank you. The key point that I want to make is, so impact of terms of trade on marketed surplus can be considered as positive or negative, more than zero or less than zero. Let's take the more than zero side just for this illustration. You will see that if the terms of trade is more than zero, that's positive, right? Then there are two ways in which the interaction would happen. First, a positive one. terms of trade is improving. If terms of trade is improving, prices are rising relatively. Prices are rising means you can get a higher income by selling the crop, which means that self-consumption is costlier. Self-consumption is costlier means self-consumption may fall and marketing surplus may rise. That's quite possible. It will happen, right? But remember that the reverse may also happen, which is that terms of trade is rising, farmers' incomes are rising, and if farmers' incomes rise, they may decide to consume more. You can actually have a higher self-consumption at that level of income compared to the earlier lower income, which would mean that marketers, they would sell less and eat more. In other words, they could afford to sell less and eat more because prices are higher. In that case, marketed surplus will fall, not rise. And the desired increase in production is not going to happen. This is a classic microeconomic story that we but to apply it in this context would mean that the terms of trade argument comes to be seriously questioned. One more story I'll tell you, another microeconomic story between the conflict between wealth effect and substitution effect. Now here you will see the wealth effect playing in one direction and the substitution effect playing in another direction. Terms of trade will rise. Terms of trade will rise means farmers' incomes are rising. Farmers' incomes are rising means they may send lesser people to family labor, assuming no hired labor, of course. That's the assumption in this story. Assuming no hired labor, the farmer may withdraw people from family labor, which would mean that the farm is less well managed and so on, and productivity may fall. But the opposite substitution effect would mean the terms of trade rises, farmers' income rises, and farmer wants to take more advantage of that higher income. So he'll put more people or more intensive use of family labor happens in the farm, which means output will rise. That's possible. But the first is also possible. In other words, the relationship between the higher terms of trade and a desired increase in acreage or production is very complex. It's not straightforward. It can run both ways on many occasions. And there are multiple soil, climate, and irrigation factors which militate against a very neat operation of the terms of trade principle. This is something that the liberalization policies did not take seriously at all. That is, non-price factors were ignored during this period and price factors were given much higher emphasis. Number one. Let me come to the second point. This is related but different. Is Indian agriculture net taxed or net subsidized? You will see a lot of papers by Professor Ashok Gulati and others. They will be arguing that Indian agriculture is net taxed, right? And that's the argument that I'm trying to oppose in these slides. I think Professor Ashok Gulati is completely wrong. Okay, and I'll tell you why I feel he's completely wrong. What is the argument here? The argument here is the following. Are incomes of farmers kept artificially depressed? That's a question. The argument of those who argue that there is net taxation is they are kept depressed. How? Net taxation exists because you have not allowed trade to happen freely. Net taxation would disappear if you allow farmers to trade freely. Number one. Number two, it will disappear if you allow domestic markets to be free. That is, remove all government regulations. That again will lead to end of net taxation. Please stay with me for one more slide. I'll give you an equation and I'll explain what I'm trying to say here. Similarly, the argument is that if there were more liberal domestic markets and freer global trade, the prices received by farmers would rise. Now, what does this mean? This is essentially calculated using a very faulty methodology. Net taxation is calculated using a very faulty methodology propagated by the OECD. Right? The issue is the use of two, they're same. They're called effective protection coefficient, EPC, or producer support estimates, PSC. This is the estimate. This is the number that you use. This is the variable that you use to check whether you are net subsidized or net taxed. What does OECD say? OECD says This is essentially a ratio between value added measured at domestic prices and value added measured at international prices. It's a ratio. Value added measured at domestic prices divided by value added measured in international prices. Right? In other words, if international prices are high and domestic prices are low, then support is low. Low to the extent of being negative. That means net taxation. Right? If international prices are lower than the domestic prices, that is, domestic prices are higher than the international prices, the ratio is higher. The ratio is higher means you have a positive value. You're not net tax, but net subsidized. This is the argument. So it has nothing to do with what you understand by the term net taxation. Agriculture is anyway not taxed. We know that. Then what is net taxation? Essentially, it's a price story that is being told, right? So this has two components. Producer support estimate has two components: MPS and BOT. This is OECD methodology. If you see MPS means market price support. That means it is the gross transfers to producers. This is an OECD definition. Gross transfer to producers arising from a gap between the domestic price and the international price for a commodity. This is MPS. So if the domestic price is low and the international price is high, this will be negative. Am I right? Right. Now, BOT is budgetary support. All budgetary expenditures on policies that support agricultural production. This is anyway likely to be positive. Okay. So essentially, PSC is expressed, you get this value, and then that value is expressed as a ratio or a share of the total value of production in agriculture. That is what ultimately gives you the extent of taxation or extent of subsidization of agriculture. Now, this is how it is essentially calculated. It has nothing to do with subsidy policy of the government or anything. Nothing. It has to do with what the global price is and what the domestic price is. That's what governs MPS. BOT is budgetary support. Now, look at OECD's latest report, which a lot of people were using during the farm law agitation that was happening. According to that OECD report, the producer support estimate for Indian agriculture was minus 6% between 2014-15 and 2016-17. This report was prepared by Professor Gulati in India. OECD had contracted it to him. This negative minus 6% is the number that is given to argue that Indian agriculture is net taxed. If it had been positive, for example, the PSC in OECD countries was plus 18.2%, because international prices are determined in those markets. So their domestic prices are likely to be closer to the international market. Plus you add BOT to it, it'll be positive. In countries like India, where domestic prices are lower than the international price, this is likely to be negative. So India had a negative MPS, but a positive BOT. And the negative MPS was larger than the positive BOT, and that's where we ended up at minus 6%. So this is essentially used to argue that Indian agriculture is net taxed. Now I'll tell you why this is completely wrong to argue that it is taxed with this minus 6%. One, what is a philosophy here? That is, you are measuring a distance between the domestic price and an international price. And you're assuming that all Indian farmers, if free trade happens, right, all Indian farmers can get that international price. And hence the difference between domestic price and international price will shrink or disappear. And this minus will become plus. Will that happen? Will that happen is a question. First, take, for example, crops like rice, wheat, pulses, etc. You largely produce them for domestic consumption. And domestic consumption has a price logic to it. That's why we fix the minimum support price in a particular way. We have issue price in the Russian shops in a particular way. These goods are hardly that we export some rice now, largely basmati rice and so on, but largely other forms of rice are not exported. Wheat is also not exported. In fact, in many years, we import wheat into India now. Pulses, we don't export. Millets, we are hardly self-sufficient. So in other words, none of these major crops of Indian agriculture doesn't make any sense to argue that there is a benchmark of international price which you can get. That argument has no meaning because we don't export it. Right? You don't export it at all. So there is absolutely no point in arguing that a commodity which is not exported at all or exported in a rather minuscule scale is used to calculate such a ratio where the international price is treated as a benchmark. That international price has zero meaning in that concept. Number one. Number two, international prices in agriculture are notorious for being volatile. International prices of agricultural goods are controlled by handful of multinational companies who are trading in that market. Anybody knows that international agricultural market is notoriously imperfect, notoriously monopolized, and notoriously volatile in its price behavior. So any change in price of international commodities will immediately be transmitted into the denominator of this ratio in India, and the ratio goes boom, 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 boom. It goes north, south, north, south. Are you going to have a trade regime which follows today's positive, tomorrow negative, day after tomorrow positive, the fourth day negative? How can you calibrate a trade policy according to those kinds of fluctuations? It's impossible. So that's the second important problem. Third important problem is nobody says this while WTO agreement is discussed. WTO agreement was signed and every country was told that you can have an export-oriented growth path. And India was told that you can have an export-oriented growth path. But then this promise was not given to one country called India. It was given to 120 countries. So Vietnam started exporting, Bangladesh started exporting, everybody started exporting. And at that point of time, if you see the total value of global agricultural production, which was traded in the international market, it was only 2% at that time. That is the share of global agricultural production traded in the global market, that is exported, is 2%. In other words, it's a very narrow market. One calculation shows at that time, India, I don't remember the author, India was exporting 5% of its paddy to the global market. Suppose India was exporting 6% of its paddy production in the international market, what would happen? There was a general equilibrium model which looked at it. So increase of exports from 5% of production to 6% of production by India would mean that global paddy prices would fall by 20%. Right? In other words, the market is so narrow that you simply do not have any scope to export beyond a particular scale. So because OECD tells you, oh, you have to reach the denominator, and you try to raise the numerator by opening up exports, every country is doing the same thing, the international price itself would crash. In other words, the denominator would crash. And the numerator, you would be very happy because the ratio has become positive. Has it changed anything on the ground? Nothing. So, in other words, this argument of net taxation has no meaning conceptually in how Indian policy should be in agriculture. It is a completely nonsensical argument. Let me say this. It makes no sense to anybody who looks at that methodology carefully. Right? So look at fluctuations and PSCs. This will show you why I'm saying this. PSC for Indian agriculture was 1.9% plus 1.9 in 2000. You will see that it fell to minus 14 in 2004, then minus 20 in 2008, minus 27 in 2013. Then it rose to minus 3 in 2015, minus 5 in 2019, right? These fluctuating PSCs tell you nothing about whether the Indian farmer is taxed or subsidized. It only shows that international prices have been volatile, nothing else. And if you, looking at that international price as a benchmark, try to set domestic policies based on that benchmark, you are doomed. because you simply cannot catch up with that fluctuation, number one. And you're simply not going to gain anything for your farmer. So this is the second important issue that I wanted to bring to your attention. Then comes the question of subsidies versus investment. That is a third point that I wanted to discuss today. Now, this is a story that you all would have learned in your textbooks or the literature that you study in the classroom. This is extent of gross fixed capital formation in agriculture, public, private, and total. Now, what does this tell you? When I was a student here, we were studying papers by B.D. Dhawan and others at that time, where the argument essentially was that from the 1980s onwards, public investment in agriculture as a share of agricultural GDP has been stagnating or falling, which was indeed true at that time. So public investment in agriculture was falling. Now, this trend, if you will see, it has continued throughout with some changes here and there. Public investment in agriculture has not picked up. That is a reality of our country. There was a short period between 2005 and 2008, coinciding with the high growth rate of agriculture, that saw a rise in public capital formation, largely because of the efforts of Professor Abhijit Sen, who was a member of the Planning Commission at that time, who was very eager to raise public investment at that time. Some money was kept in there, but after that, you will see that ratio has fallen again. And if you look at the new base series of 2011-12 also, you will see fall of public investment or stagnation of public investment as a share of agricultural GDP. Now, the same BD Dhawan papers of that time, which we studied in TNAU, told us another story also. That was that public investment and private investment are complementary. Now, the argument was that if public investment rises, it will crowd in private investment. So if a canal is built for surface water irrigation, farmers will invest more in smaller canals, which will pull water into their fields, which will be private investment. Right? So many sort of rural electrification, for example, if government investment in rural electrification, farmers will go and buy pump sets. Right? So public investment and private investment are complementary. That was what and this complement, because public investment fell in the 1980s, private investment also fell. That was what we studied in DNAU. That was correct till that time. But then after that, if you look at the trends, there are others who have written about it. Professor S.L. Shetty has a paper in my book where he deals with it in great detail. You will see that the complementarity has disappeared. What is the story here? Even though public investment has stagnated, private investment has risen sharply. That is a story that you see in the 2010s and 2000s and 2010s, the last 20 years. If you see, the complementarity is no more true. Private investment is rising despite a stagnation of public investment. That is the story that is very important to note, because the old consensus now has disappeared. Public investment does not anymore crowd in. It does, but even without public investment, private investment has been growing. So complementarity is breaking down, and private investment has now become autonomous in many ways. And this autonomousness, if you look at the data very carefully, comes from a particular 2 or 3 sources, which is A, tractors, B, tube wells and bore wells, and 3, farmhouses. These are the 3 areas. If you look at All India Debt and Investment Survey reports, you will see that these are the areas where private investment is picking up. So essentially, you'll see 62% and 57% of fixed capital formation of farmers was in tractors or tillers or digging of tube wells or bore wells. Now, this is what I call as autonomous, because now the investment by farmers in groundwater, there are a lot of scholars here who are experts in study of tanks, etc. in Maharashtra. So in Tamil Nadu. So they know more than me on this. There's a huge shift that has happened from surface water irrigation to groundwater irrigation. This shift from surface to groundwater is largely because of autonomous private investment by farmers in tube wells, bore wells, etc. Now, the absence of public investment in surface irrigation has meant that this enormous investment in groundwater has negative externalities. If you see, I have numbers in my write-up, you'll see the number of critical areas in groundwater, number of semi-critical areas in groundwater, etc. If you check the data, you'll see the groundwater levels are falling drastically in India. As a result, why? Because there is an intensive use of groundwater. This intensive use of groundwater, in my argument, is a function of falling public investment in surface irrigation. That is why farmers took this autonomous step of investing in bowels and tubers, which has had negative environmental implications. Now, you'll see this data here, these are numbers from the All India Debt and Investment Survey, which essentially show what I was trying to say. You will see all these, the last 3 rows are investments in transport equipment, wells and irrigation machinery, etc., which are essentially autonomous. So the point is, because the complementarity has broken down, we cannot argue that public investment is no more important, because absence of public investment has led to negative externalities. And public investment in surface irrigation continues to be important if you want to address the problem of these negative externalities. So raising public investment is important, number one. This is where we come to the related point, which is, why is public investment not rising? Public investment is not rising because input subsidies are high. If input subsidies are cut, then you can raise public investment. That is the argument of those who support the liberalization argument of cutting subsidies. Now, in my view, this is also very problematic. This counterposing of subsidies and investment is also a very problematic argument in my view. Why is that? First, you will see input subsidies are argued to be cut for a reason. It is argued that they lead to an irrational use of these inputs. Right? If prices are kept too low, farmers will overuse fertilizers, water, electricity, etc., which distorts the market. But then, if you look closely at the problem, is it just the low price or subsidy or free electricity which leads to this overuse? No. Careful studies will tell you that awareness of farmers is a very important variable here. The strength of the agricultural extension system plays a very important role in this matter, but we have in almost every state in India, agricultural extension system is as good as dead. Public agricultural extension is as good as dead. Then this third important question is, why are we giving subsidies? Why were input subsidies begun in India? It was begun as an incentive for farmers to adopt riskier and newer technologies, fertilizer, pesticides, or any other. Right from the Green Revolution time, you wanted to incentivize farmers to adopt more of these technologies. Now that was why. So there is a growth element to the subsidy story, which must be factored in. The rise of productivity, the rise of production, rise of farmers' incomes that result from the use of inputs, which are purchased at lower prices. That has to be factored into the story. It's not enough to say, oh, input subsidies are burdensome to the budget and so on. That story is not sufficient. It has to be a larger canvas in which you look at the problem. Also, in many cases, subsidies act as compensation for distortion in capital market. For example, if you remove all subsidies on fertilizers and you expect farmers to take loans and buy fertilizers as a compensation, right? I'll keep interest rates low. You can borrow and buy fertilizers at market prices rather than subsidized prices. But then what happens if there are imperfect capital markets? There are no banks, or banks don't lend out. What will happen? So it does not sort of fit in as a perfect substitute in that story. So that is one set of problems that you have. Second is this another set of arguments that you will see. Most subsidies are taken away by richer farmers. That's also not fully true. Acharya and Jogi in their paper in 2004 as a calculation where they show that if you take subsidies going to small and marginal farmers, it's about 36%. And while their share in the operated area is also somewhere around 36%. So that's sort of proportionate in terms of their area, share in area, and the share in subsidies that they receive. Do subsidies constitute a fiscal burden? There are questions. That's again not a straightforward. There is no straightforward answer to that problem, because to begin with, if input subsidies were absent, if less inputs were used and productivity had fallen as a result, then the government would have had to face higher inflation. Lower production coming into the market will raise market prices, which means that you will have to invest separately in reduce inflation, to contain inflation, which money you could have spent in providing input subsidies in the first place. Right? It cancels out. Right? Second is, if food prices remain low as a result, because wages in industry are linked to the inflation, but wages in agriculture are not, but wages in industry are, right? If food prices are low, then the wage bills of industry would be low, right? But if food prices are high because you withdrew input subsidies, then the wage bills of industry and the government, your dearness allowance, etc., all of that will have to be raised. That's also a fiscal burden on the other side. That's the second important. The third is, in this case, there is a difference between social valuation and private valuation. Private valuations may be different from social. Input subsidies may have higher social valuation compared to their private valuations, which in turn will give you a very different story altogether. Then come to whether subsidies are a substitute for investments. The key problem, I will not I'll not sort of push it further. I'll just say that there is absolutely no relationship that you see if you look at the data. If input subsidies have fallen, has governments of the day decided to divert that money to public investment? No. A reduction of subsidy is a saving for the government. That money goes somewhere else. It is not diverted to higher public investment in agriculture. So the political economy of budget financing is such that any fall of subsidy is unlikely to lead to higher public investment. That's all public finance people will tell you exactly the same story. Finally, this is the present government's argument. They argue that if you actually allow subsidies to fall, input prices to rise to market prices, you can actually compensate that with higher MSPs. You can increase the MSP and you can compensate for a rise in input prices. Is that true? No, or rather only partly true, because for most farmers in India, which we know, most small and marginal farmers, the marketed surplus is almost minuscule or zero. Most of them have self-consumption as the most important component of their decisions. And this would mean that a rise in input price would mean a higher burden on these households who are largely using their production for self-consumption, because they will have to pay more for inputs and yet they're not selling anything out. So they don't benefit anything from the higher MSP. It's a loss for them. Second is, which is an old story, that small and marginal farmers are largely net buyers of food. Right? And higher MSP can mean higher food prices, which will actually negatively impact their incomes. Right? And finally, you don't procure from everywhere. Even if you raise MSP, you procure from only a few geographical regions of India. Farmers in the rest of the regions are unlikely to benefit from that rise in MSP. So this subsidy story, that counterposing subsidy against investment, is also not a story that would sell well. If you look at it closely, you will see that they're not substitutes. They perform very different functions. Right? Subsidies are not a perfect substitute for investments and vice versa. They perform different social functions and they have to be seen separately. And you cannot argue, as supporters of liberalization have done, that a fall in subsidy can lead to higher investment. That has not happened. That will not happen also. It's a false equivalence you're drawing between the two. That leads me to my last point. I have looking at my watch and I've maybe I have got about 5 to 7 minutes left. I'll complete my point there. This is my final point, which is related to agricultural credit and financial liberalization. Now here, what is the key? If you follow the Narasimham Committee report, which suggested that banks do not open more branches in the rural areas, which suggested that priority sector should go away, which suggested that differential interest rate scheme should actually go away. That Narasimham Committee, which is like the Magna Carta of financial liberalization in India, you will actually see that the key argument in all financial liberalization stories is the interest rate deregulation. Interest rate is the price in that market. The demand supply is equilibrated by the price. Similarly, demand and supply for credit is equilibrated by the interest rate. The key argument of financial liberalization is deregulation of interest rates. Without deregulation of interest rates, there is no financial. It's like you free a whole market and keep the price under government control. Can you do that? Then the market is not free. You're keeping the price under government control, right? So you have to free the price. Only then the market becomes free or close to perfect, as we call it. Here, the credit market has to clear. You must deregulate the interest rates. That's essential necessity. Now, the point about financial liberalization in India, right at that point, in my view, is faulty. That's the point that I'll try to make here. What was the argument? I said earlier, you have to delink monetary policy from the objectives of redistribution. Monetary policy is to focus only on inflation targeting. If you have to redistribute anything in the economy, it's a role of fiscal policy. Do it through your budget. Don't burden the banks with the agenda of redistributing income or assets in the economy. That's the argument here. So banks should essentially not focus on increasing economic growth, increasing employment. Those are not their job. That's a classic position here. Their job is to contain inflation. You raise interest rates up and down, you adjust credit supply in and out, and you essentially try to control inflation or prices. That's the story here. Now, just like it was argued that the earlier regime promoted or skewed the terms of trade against agriculture in the terms of trade story, as we were discussing earlier, the argument here is a parallel, which is that the social and development banking regime after bank nationalization in 1969 promoted financial repression. What is financial repression? There's a context here which we need to understand. There was a post-Second World War view, Arthur Lewis, Rosenstein, Rodin. If you look at the literature of that sort, you will actually see a certain consensus in the literature, which was that I've summarized it in 3 bullet points there, which is A, it is economic growth that precedes the growth of finance. Finance does not lead growth. Growth leads and finance follows. Number 1. That was a consensus at that time. Second is higher savings are an outcome of growth. Growth happens, people have higher savings, they put it in the bank, savings rate increases. It's not like savings rate must be raised and then growth happens. That doesn't happen. Growth happens first, which leads to higher savings. Finally, growth happens, there is more higher savings. This will lead to higher demand for credit because there are more new institutions, new instruments, etc., which are created in the financial market. This was the consensus at that time. But financial liberalization completely changed the story. The premise itself changed. What is the new premise? The new premise is that finance precedes growth. It is financial development that leads to higher economic growth. Number 2, this financial development leads to the development of new financial instruments and new financial institutions. And this higher create its own demand. Remember, Jean-Baptiste say, supply creates its own demand, right? Which Keynes was opposing during the Great Depression. So just like that argument, the parallel here is supply of these new instruments will lead to a new demand for them. This was the new. So this is where the financial repression literature has to be placed. Allow me to give you a little graph. So I'll finish it quickly. I'm very sorry. So this is the supply of credit. This is sorry. This is savings in the economy. This is investment in the economy. I'll come to supply anyway. The SS is savings curve and II is the investment curve. You can see very clearly that there's an upward sloping savings curve because higher interest rates will lead to interest rates. It's in the y-axis. Savings and investments are in the x-axis. So you will see higher interest rates will lead to higher savings. That's the assumption here. Right? Higher interest rate means you'll put more money in the bank, more savings are there, so savings rate will rise. Similarly, higher interest rate will lead to lower investment. So investment curve is downward sloping. Simple. Now, there is an equilibrium as always at this point, which essentially means that there is an equilibrium interest rate of RE, right? Which it clears the market essentially at that point. Now, this is the free market, right? But then financial repression is an argument against government regulation. What does governments do in financial markets in developing countries? They regulate interest rates. They put ceilings on interest rates. You cannot charge more than X% interest rate, right? You have money lending laws, you have usury laws, you have the administered interest rate regime, so to say. So government is actually setting a low interest rate, RC, call it R ceiling, RC, okay? So which is a lower interest rate compared to the equilibrium market related interest rate. That is this line. Right? At that level, what is the savings? Interest rates are low. So savings would be falling. Savings are lower. That means savings are here. Right? At that level, savings are SC, savings at the ceiling, right? And investment can only be that much because savings are supposed to be equal to investment. So IC is the investment at that ceiling. So essentially what happens is because of a fall of interest rate, because of a administering of interest rate, because the government set a ceiling on interest rate, your savings are falling from E, which would have been SE to SC. Your investment has also fallen from IE to IC. At that interest rate of RC, what is the demand for credit or demand for investment? Here. Because at that point, here is where it intersects the II curve. In other words, ID is the investment demand. Right? ID is the investment demand, and IC is the actual investment that is met by credit. In other words, ID minus IC is actually the demand for investment which is there, but which is not met by the banks. In other words, banks are rationing credit. Banks are giving only where ID is the demand for investment at that interest rate, but banks are giving only IC because they have only that much savings, SC. So this means that any administering of interest rates would lead to fall of savings rate and fall of investment rate in the economy. This is the classic financial repression model by Ronald McKinnon and Edward Shaw in 1973. Independent arguments. Okay. This has been the holy cow, the Bible of financial liberalization across the world. Why should interest rates be liberalized? You look at any economics textbook of the mainstream variety, it will tell you interest rates must be liberalized or financial liberalization must be done because financial repression must be removed. What is financial repression? The lowering of savings rate and the lowering of investment rate because of a ceiling of interest rates. So savings rate and investment rate will fall if you administer interest rates. This is why government should free the financial market. This is why there should be financial liberalization. This is the argument. What is the problem with this argument? I wish I had more time to deal with this, but what is the problem with this argument? The problem with this repression model is there's been huge criticism from the heterodox school on this argument, which is essentially the following. This is a monetarist argument. The monetarist school essentially argues that money supply has no relationship with the real sector in the economy. They don't believe that money supply in the economy has anything to do with real growth rate in the economy. They think they are two separate compartments. Money supply for them is exogenous. Right? The government can keep it up or down. like a tap. You can increase money supply or reduce money supply by using interest rate as an instrument. You can increase interest rate and reduce credit. You can reduce interest rate and increase credit. Right? So that's possible for government to do. Now, this exogeneity is the core of the problem in this monetary school. The heterodox view would tell you that money supply is not exogenous, but endogenous to the system. It is not exogenous, it is endogenous to the system. What does it mean? It means the quantity. If there is higher demand for credit, a lower savings rate will never constrain banks from lending more. Banks can always lend more, irrespective of the savings rate. That is the argument. If you look at it closely, if there is higher demand, the banks can always, because all money is not taken quickly. Money is given as installments. Some money is given first. That money will go first, increase growth. It will come back as higher savings, feed banks with more savings that can be given as higher investment again. So the heterodox view completely disagrees with the point that money supply is exogenous. It says it's endogenous. In other words, quantity of bank credit is always demand determined. So this ID minus IC that the financial repression model postulates is a meaningless point for heterodox people. That doesn't matter. So what if the savings rate is SC? You can always give SD. That's what they would say. Look at India. Financial liberalization has happened for 30 years. Has the government freed interest rates in the economy? It appears yes, but in fact, no, because every 6 months, the Monetary Policy Committee announces the policy rate. All other rates in the economy, including your deposit rate, your savings banks interest rates, the term deposit rates, etc., are all fixed as a markup by banks over those policy rates. Where is liberalization? There's no liberalization. The government is continuing to fix interest rates. There's one more story here, which is very important. What do banks do? Banks essentially in this situation, the RBI fixes what is called as a repo rate. And repo rate is the rate at which banks deposit money with the RBI. In the period of financial liberalization, what has happened is banks are hesitant to lend to farmers. Banks are hardly lending to farmers. Instead, what they have done is they are parking the deposits that come into them with government securities or GSECs with the RBI at the repo rate. Right? And they are not lending adequately to the priority sectors. Why do I say this? Look at this. You all know what is a statutory liquidity ratio. It means if the bank has 100 rupees deposit reserve, 18 rupees must be compulsorily deposited with RBI. That is a statutory liquidity ratio, SLR. It means tomorrow if the bank fails, there will be some money left to rescue the bank. So 18% is the SLR. Only that much is supposed to be kept by banks in the RBI. How much do banks actually keep? 30%. They need to keep only 18%, but they keep 30%. Why? Because they don't want to lend to farmers. It's equally profitable for them to keep it with the government securities in the RBI. What is this? Rationing. Where did rationing disappear? Financial repression was supposed to be eliminated and credit rationing was supposed to be eliminated. Has it? No. It's still credit rationing at the is quintessential credit rationing. This 18 to 30%, the difference between 30 and 18 can be lent out. The banks are not lending. This is why you see very closely the literature on this. Even those who support liberalization of Indian economy, Vijay Joshi, IMD Little had a famous book in 1998, The Indian Economy and Liberalization. There they show actually that in the period of financial repression in India, India actually saw a very sharp rise in savings rate. Rise in savings rate, not fall. Savings rate rose from 13% in 1969 to 38% in 1991. No developing country has seen this kind of a trend. If you look at the share of advances or credit to GDP, it rose from 10% to 25%. So savings rate rose, investment rate rose. When in the period of high time of financial repression in India, then how can you say that financial repression leads to lower savings rate and lower investment rate? It's the opposite that is happening in India. So Joshi and Little, the famous book, they argue that the increasing degree of financial intermediation was closely associated with the very rapid spread of commercial banking throughout the country after 1969. This spread contributed to rise in household financial savings and in the rise in overall rate of saving. Financial repression was therefore mild. In fact, they should have said it's not at all there, but they say it's mild. It's okay. And any deleterious effect on savings were quickly offset by the rapid spread of banking in the rural areas. This means that if you look at the All India Debt and Investment Survey reports, these are my last two slides, you will see these are different variables. Incidence of indebtedness, how many people are indebted. Number two, debt asset ratio. Number three, share of institutional sources in total debt. That's what we are interested in. How much are banks lending? Let's say commercial banks. In other words, this 42.6 that you see here is a result of a government constantly telling the banks to lend more, right? For example, in 2012, there was a Nair committee of the RBI, which essentially said, no, there is 40% priority sector target in agriculture. There is 18% target of the priority sector. And in 18%, they insisted that 7% must compulsorily go to small and marginal farmers. That is when this shift became evident from 27 to 42. Till then, it was not happening. You look at money lenders, which is the lowest, it is still a serious problem. Financial liberalization led to the return of money lending to India, which is very important to note. All of us have, when I was studied, we were looking at data till 91, and we said, money lending is being substituted by public banking. Look at what is happening after that. 17 rupees was coming from money lenders out of 100 rupees, 26.8, 31.5. Then it fell because commercial banks increased, but then this 22 is still higher than 17.5 of 1992. In other words, compared to 1992, today money lenders lend at least 5 to 6 rupees more per 100 to cultivator households. Right? So this has been the adverse impact of financial liberalization on the other. So this is money that banks could have lent to agriculture, but they parked it in the government securities. It is because they did not give that this happened. Right? I'm going to skip a few more slides and I'm going directly to my conclusion. Right? So what is the story that I was going to say? I was saying that over the long period of reform between 92 and 2020, agricultural growth rates do not show any significant pickup. They have slowed down relative to the 1980s. Economic liberalization focused on terms of trade, getting prices right, reversing net taxation, etc. But these arguments are conceptually questionable, and there is no evidence that they led to higher economic or agricultural growth in India. Economic liberalization also focused on substituting subsidies with public investments. But the growth of public capital formation has continued to stagnate. The autonomous rise of private investment, particularly in borewells, tubewells, etc., has had negative externalities. Input prices and costs of production have risen because input subsidies have fallen, and profitability in agriculture has stagnated or even fallen in many crops. My book has a series of graphs which will show this fall of profitability in a range of crops in agriculture. There is a chapter by Ashish Kamra, which is very detailed in a crop-wise sense. Some of you may would like to have a look at it, which uses CCPC data. Now, finally, financial liberalization internalized the logic of financial repression. But financial repression as an idea has no theoretical or empirical validity. Financial liberalization leads to credit rationing, which is what we saw in terms of the investment in GSECs. and parking of deposit reserves with the RBI and not lending to farmers. As a result, expansion of rural credit slowed down in the period of liberalization, reopening the doors to money lenders. This leads to my concluding point, which is that we need a more critical approach to mainstream ideas in agricultural economics. And it's high time that in both research and teaching of agricultural economics, we give more predominance to heterodox views. I'm not saying that one approach should be shut out or anything, but we need to teach all the approaches in our classrooms, where both orthodox and heterodox views are taught to students, and we let them decide as to what they find as more appropriate. But I think the heterodox school and its arguments have historically been underprivileged in classrooms and textbooks, and I think that needs to change. And my lecture today is a little call to bring about that change in our classrooms as soon as we can. Thank you. Thank you very much.
Dr. Salwadi.
Yes, Dr. R. Salwadi Iswaran, Professor Agriculture Economics from Trichy. Thank you, Dr. RAMAKUMAR, for an excellent presentation with a fantastic hindsight, insight, and foresight of Indian policy issues. You have rightly pointed out that the falling public investments in surface irrigation induced autonomous private investment in borewell and tubewell that led to negative externality. Even our temporal data for decades together shows, not only in Tamil Nadu, not only India, but in the world, this is the one of the promising problem of unsustainable exploitation of underground water. This is the biggest environmental challenges in the whole of the globe. So what are the policy options or solutions to these phenomena? Your views on this?
Thank you. Thank you very much, Dr. Salwadi, for that question. It's a very important question, but the answer is very complex in my view. What we need to focus on in policy is higher public investment, of course, but not of the same type that we had in the past. We need a new mix of public investment, in my view. Some of that money has to go to major and medium irrigation projects, no doubt. And I think we have ignored a lot of major and medium irrigation projects for a long time. And some of the money should go there, of course, but that's not sufficient. We also must focus on more watershed based development programs. And I think many watersheds in India are underinvested on. I mean, you need much more investment to go into watershed development programs. You need more local irrigation schemes, more rainwater harvesting structures, more tanks. Those sort of requirements must also be provided adequate public investment. So I'm not arguing for a return of public investment to purely surface water irrigation. I'm not saying that, but I'm saying it should go there, but it also should lead to other areas in water management. The second is we also have studies which will tell you that higher public investment in rural infrastructure has a very significant effect on rural poverty. So if you invest more in roads, other forms of rural infrastructure, markets, and so on. I'll give you an example of regulated markets or mandis in the country. The Doubling Farmers' Incomes Committee in 2015 and 16 made this argument that India needs at least 10,120 mandis if you have to cover all areas with a particular square meter, one mandi per X number of X square meter. But we have only 6,800 mandis in India. So we need at least 3,000 to 4,000 mandis extra in India, which will also require public investment. So that kind of public investment will also lead to lower transaction costs for farmers, higher incomes for them, and better prices for them apart from stable markets. So the rise of public investment has to be in multiple areas. Rise of public investment also has to go to public agricultural research. And if you see the numbers, you will see that India invests about 0.6% of its agricultural GDP in agricultural research. Whereas if you see the average for developing countries, it is 0.7. And the average for developed countries in the West is about 2 to 3%. Brazil, which is not a developed country per se, invests 1.8% of its agricultural GDP in agricultural research, whereas India invests only 0.6% of its agricultural GDP in agricultural research. I was told by Dr. Suresh Kumar in the morning that when I was a student here, we had about 20 to 25 faculty members in the Coimbatore Center of Agricultural Economics itself. But now it appears that in the whole of Tamil Nadu Agricultural University, you have only that many faculty members. This is a sign of underinvestment. Teachers will have to spend more time in teaching, less time on research. It will have its impact on research outputs, the value of research for farmers, and so on. So it has to be multiple levels of action by the government in terms of higher public investment. I hope I answered your question.
Thank you. Thank you.
Sir, I am Dr. Saravan, Professor Agricultural Economics. So wherever, say your presentation is not new for us, but wherever you present, you are mesmerize us, all audiences with all data and analytical background. It's a very wonderful presentation, sir. Actually, one of your slides was the complementarities breakdown, public investment and private investment. But the recent NABARD research and policy series, Ramesh and the written. But this public investment on canal irrigation, for every year we are spending 17,000 crores approximately on the capital expenditure side. But in spite of that, that project is not taking up. Delay in project and minor obstacles like catchment area development, forest clearance, and interstate dispute. These things made the investment is worthless. So he considered that is a wasteful investment. But some of our research also, our objectives are very fine. While starting even every budget, their allocation, they're simply allocating for every items. But similarly, several government program, the public investment is okay, but the returns to investment is very poor. That is the problem. But this is one of the complementary point I make it. It's not the public expenditure is low, it's stagnated, but it is not worthless. It's wasteful investment that may be diverted or that we effectively monitored to get to the returns. So this may.
My answer is yes and no for the following reason. See, what you are citing is a rise in absolute spending in capital investment. But what I was talking about was as a share of agricultural GDP. And so as if you look at it as a share of agricultural GDP, it is stagnating or falling, right? Even because the denominator is rising year after year, you have a positive growth rate in agriculture. So even a marginal rise in absolute investments will also not lead to a rise in the ratio. That's number one. That's a mathematical point. But beyond that, there is an element of truth in the irrigation projects and their implementation that you mentioned. Many irrigation projects that we have were started in the 1970s and 1980s and have still not been completed. That's a one big problem. I recently was part of a committee that looked into it in Kerala as part of its planning board and so on. What we found, we looked at 4 projects, and we looked at why are these projects not completed on time. There are many reasons that we found, but one reason is, of course, and you can say no political will and all that. All that usual problems are there. But essentially, we need to reconceptualize the way our government mechanism implements these large infrastructure projects. I think the old way of doing it does not work anymore. These projects are still not in these schemes are not yet in a project mode. Land acquisition problems are block progress somewhere. In other cases, you give it to a. These are the real issues. When we looked into it, these are the real. But there is no economic theory behind this. But when the contractor takes up a project, he delays it, it goes to the court. Then the government mechanism functions based on price levels fixed. What can be the price of one brick is fixed by the government. That is fixed in 2012. And in 2018 also, you're floating a tender with the 2012 price. Nobody is coming forward and taking the tender. Now, if they come back, take the tender, they'll say, oh, now prices have increased. I need a new price. The government says no, 2012 price. Then what happens? He'll go to court and the project is finished. It sits there. The court case goes on for 20 years. Right? So these are the issues. And I think by reconfiguring the way in which governments implement these infrastructural programs, it is our irrigation departments, for example, need an overhaul. You have to look at these projects more in a very different way and ensure time-bound implementation. It's a long story. Maybe we could have a separate discussion outside. But I agree with you. It is a problem. But that doesn't mean that we must lose heart and drop those projects. I won't go there. Right. The second is irrigation department does only up to a point. As you know, after that it is taken by CADA, the Command Area Development Authority. That's a separate ball game altogether. That is a separate problem altogether. That the linkage between the two is very poor in many cases. That also is another problem that we need to worry about. Sorry, the final point you mentioned was
ascertain the return to investment.
Yeah, return is an issue. I agree. Return is, but I think my only thing would be many farmers are ready to pay for irrigation water, but I think for a long time, if you look at project proposals of these irrigation projects, you will see that they only looked at food crops, cereals, right? So if you look at the command area of many of these projects, you will see area cited is only focused on some specific crops, not all. But now cropping patterns are diversifying, your fruits, vegetables, and so on. Though they are not coming into the picture at all. And so I would urge that returns have to be more socially valued rather than financially valued. I think if a social valuation might give us better results compared to private or purely financial valuations. But I agree with you. There is a point in what you're saying. We need to resolve it, but it needs different answers at different levels. It's a very complex thing. I don't think I've answered your question. I know that's because it's a very complex problem out there.
I have one more question, but I will ask later.
From student side. From student side, no?
Good evening, sir. My name is Divya. I am pursuing my second year PhD. So, I want to know your views about direct cash transfer to farmers, sir. How it will contribute to agriculture, whether it will contribute or not. Sir, I want to know about. Okay, sir. Sir, I want to know about your views regarding direct cash transfer to farmers, whether it will contribute, like PM Kisan.
Now, it's again a very complex matter. It's not going to be an easy implementation. For one reason, I'll tell you one example. Please sit down. Take for example, the first cash transfer scheme, for example, Raitu Bandhu in Telangana, right? Or Kalia in Odisha, or PM Kisan at the national level now. Who is a farmer in these schemes? Who is a farmer? A farmer is somebody who has got a land record. Okay, who has got a land title. He is a farmer.
Minimum ceiling, sir.
Huh?
No minimum ceiling.
No, I'm not saying that. Minimum, maximum, you leave it. Okay. Do you have an accurate land title? The land records in India are primitive. Right? There is no way to say that. Look at land records. It may be the name of Ramkumar in the title, but if you go and look for Ramkumar, you will never find a Ramkumar because Ramkumar died 50 years back. Right? His 3 children are cultivating that land. Maybe their grandchildren are cultivating that land. They never change the land record to another name because changing that will require a new registration. It will require payment of new stamp duty, etc. Nobody wants to spend that money. Let it be there. It's our family land. It will be there. So, in PM Kisan, who is eligible to receive 6,000 rupees per year? Ramkumar. Where is the Ramkumar? He's dead. Is there a bank account in his name? No. Right? In many landowners in Telangana, Raitu Bandhu, for example, we did a study on that. They are in Delhi, okay, or they are in Bombay, etc. Money is coming to their account. Are they the farmer? No. Who is the farmer? A tenant. Right? Does a tenant receive? Is actual cultivator? Is he the person who gets land cash transfers? No. Right? What should he have to have the transfer? Land record or land title? Does he have a land title? No. He's a tenant. The tenancy is oral. Andhra Pradesh has 30% of land under tenancy, or Telangana has. So what do you do? Second problem. So unless you set your land records right, update land records, and make them accurate, there will always be huge exclusions in direct cash transfers in agriculture. Telangana made an effort. They ran a scheme called the Land Records Updation Program, LRUP, to set this right. They also created a land management portal called Dharani to settle this. End of last year, there were huge protests across Telangana because every land record that was supposed to be new, every land record that was renewed and made quote unquote accurate, had innumerable number of errors. A cabinet subcommittee decided to dump 3 years of effort and decided to do a digital survey using LIDAR, using what is called as a coarse technology and so on. So it is very difficult to update land records and identify who is the farmer. Number one. Number two, tenants are excluded from land records in a big way. Number three is that, what is, for example, now we are thinking of direct cash transfers in lieu of fertilizer subsidy. Okay, so fertilizers will be sold at market price, and the difference between market price and the subsidized price will be paid to the bank account of the farmer. Now, who is eligible for this? Who will be eligible? A. Ramkumar goes to the fertilizer shop, buys 50 kilograms of muriate of potash. Then it has to be paid to me. But I can buy more than the extent of land that I have. I may want to sell it in the black market. Okay. So my land area has to be there. My land area will have to be there. Then they will look at a scientific application ratio of per hectare, how much MOP should be added. And only that much MOP I am eligible for subsidy. Right? But then where is that accurate land extent of land in the record? There is no record. Right? In other words, you are talking about another database, which is the revenue department, land records. You're talking about the list of farmers in the agriculture department's list. You have to reconcile these two. You can say you got an Aadhaar number, but despite Aadhaar, to link these two, there are numerous exclusions in both. So, in my view, direct cash transfer is something that we should go very carefully into. It can lead to huge exclusions, and you have to be very careful in doing it. The final problem is if you leave it to the market. Okay, I'll give you the example of kerosene subsidy in PDS. So the parallel here. They did pilot projects in different places. So kerosene will have to be purchased from the ration shop at market price. Let's say 25 rupees. You would have got it otherwise at 5 rupees, but now you have to buy it at 25 rupees. 20 rupees will come to your bank account, right? 25 minus 5 will come into your bank. You still effectively pay 5. That's the idea. But then you stop buying from the ration shop. You go to the open market and buy it. Does the open market have enough supply of kerosene? No, because markets are fragmented. Kerosene doesn't flow from one shop to another depending on demand. And as a result, kerosene prices will rise to 30. Right? What is the cash transfer that you get? Still 20. So what are you paying? Not 5, but 10. So the value of transfer is devalued if there is inflation. And can government constantly adjust cash transfer based on changing prices? No government does that. So you run the risk with inflation of a devaluation in the value of transfers in such cases. This can happen in fertilizer also. Right? So that's why I say that it has to be done very carefully. There can be many exclusions that might result from such a policy.
Thank you, sir.
Maybe Suresh,
Sir.
I will add a few more
Oh,
points
okay,
here.
sir. Okay.
And I join you all to welcome Dr. Ramkumar. And he and I think Dr. Sam, they used to be twins from Kerala Agricultural University in those days. I very well remember. Anyway, it is very nice. I think sometime back I was talking to Suresh that advising him to invite you, but he said already we have invited. Only we are expecting him to come here. That is one thing. So coming specifically, I enjoyed your presentation, Dr. Ramkumar, today, and definitely it's very difficult, the understanding Indian agriculture, its complexities. It is of course, growing day by day, and we all know, as a student of agricultural economics since 1970s, I have literally seen what is happening in agriculture in this country. So that way I grew up as a Green Revolution student, all this kind of subsidies, all those things. Okay, I think your first table, regarding this growth rate, my argument is, of course, it is 1.6 or 2, something like that. But what can we expect more than this? That is my point. Because if you really go deep into the, of course, latest decade or so, your last period, like milk production, horticulture, maybe some fisheries must have helped you to increase. I don't know, you have included those subsectors in your growth rates. In that case, you may see some difference in that. So by and large, of course, globally, this is the phenomenon. If you really see the past at least 70 years or so, we always have different base periods and there's growth rates. Sometimes we climb 4% up to like Ramesh and others, they used to claim 4%, 3% to show agriculture is doing better. All these kinds of things are there. So that is one question. Then regarding this terms of trade, really we are using the input price indicators and then output price indicators. Are we, including this subsidized price in terms of industrial inputs, particularly fertilizers, electricity, and then chemicals like tractor subsidies, all those things. So it is not maybe a question to you, it is a general issue. How far, are we following the same methodology we are used to have 50s, 60s, and 70s still, or have we rectified that that kind of issues? Then, of course, coming to third point, this fertilizer, sorry, subsidies, agricultural subsidies versus investment is really a issue that, it is always, I think, according to me, it may be both sides of the same coin actually, because as a person, I see day to day, happenings in the farmers field. As you know, last year and maybe before, because of this COVID and other things, fertilizer prices in the international market, that is our raw materials, have more than doubled. I think even Government of India last year increased the fertilizer subsidy from 70,000 crores to 140,000 crores, something like that. So my argument would be, as you said, I think you also concluded the same way. I think, because removing subsidy may not be a solution, because what will have to immediate impact on the food production. Even a 10 million shortage in food production will have lots of impact on a country with 1,450 million people. So this is the worry we have to see. Really look at the consumer side. People also argue for and against this holding huge grains in our godowns and so on to ensure food security. This is a matter, I think, if you really reduce, because to my knowledge, if you take from what happened in Erie and rice, we have analyzed across the Asian countries, water and then the high yielding varieties and fertilizers, these really contribute to 70% production in whole of Asia, including China and so on. So that way, this fertilizer is a key component. Then of course electricity and so on. And here actually we also, there was questions about this public investment. Certainly, what you invest in fertilizers, sorry, subsidies really impact on the, public investment. Because, my argument is again, what has happened is fair, that is what my feeling, because as a student of agricultural economics, I have been observing. Because I say this is all this over exploitation of groundwater is a demand driven basically. What else farmers do actually? So of course on the conservation side we must have educated farmers and would have done well. All these things are there, like your watershed development, all those things. So my feeling is what we say, until 1969 when Indira Gandhi nationalized the banks, there was a lot of criticisms. But if you really look at, our own people who have worked in NABARD and other, many research actually shown this really this opening up to agriculture in terms of priority hectare really has again helped what we are claiming today, 317 million tons, and then our cotton 350 lakh bales, all kinds of things. So that way, we need not worry much, in spite of pro market or, the institutional intervention. My argument is I am a believer of pro market, free market, but our institutional interventions really have helped. Sometimes, of course, a decade or so, it may be bad, but sometimes that it regains, that is very important. Say this one case, in the case of, before that, I have one technical questions. You are reporting about this area elasticities. See, later in the methodological development, they were measuring both area price elasticity and yield price. Maybe because during the season or before the season, farmers are correcting themselves when there is a price rise in terms of input, because it is spread over 4 to 6 months. So this is one thing. Price, yield price elasticity, area price elasticity, if you really couple these things are add, you may get somewhat, a higher magnitude of price elasticity for the, whole production. That is a separate question. Then coming again to this MSP, we have been deceiving ourselves for the past 70 years, because MSP started in early 70s when C. Subramanian was the agriculture minister, and just only 1 minute, I will go to my. I think you are able to hear. Yeah. And okay, 1 minute. My iPad was run into that. Hello. And this MSP actually, we may not be able to implement that at all, actually, because whatever we do is for rice and wheat, mainly meant for the food security thing. And then coming to your the repression point in delinking totally money market with the fiscal policy. See, my point is, how will you, because you have to pay either in fiscal policy or monetary policy some capital to the farmers, right? So in that case, definitely making available this, I think according to your tables also about 40-45% institutional credit going to the farmers. So the interest rate is really, unless interest subvention or this 4% interest for the agricultural commodities, short-term loans, that kind of thing. So here, how will you really separate? There is some thing, closely the monetary and fiscal policies are connected. So maybe, we have, of course, many environment curves and supply and demand curves, all kinds of things. But actually, when come to a political economy, those things won't match and work. So that is one thing. I I am I may be confused. I am not clear about that. And um, so you have difficulties. We have to
Sir, your voice is breaking, sir.
Hello.
Sir, now it's okay. Voice கொஞ்சம் break
Okay,
ஆகுதுங்க
okay.
சார்.
Okay. இப்ப கேக்குதுங்களா?
இப்ப
Is it
கேக்குதுங்க
okay?
சார். Now it's okay, sir.
Okay. So this, in spite of that, what else we can do? Because I am basically for subsidies, because that will have immediate effect on the farmers. As you know, now per kg of N costs 15 rupees, 20 rupees. They close the farm and they won't go for cultivation any crops. So that way, again, in terms of infrastructure development, other things like those 5 points you made, the heterotox, I think that is essential. Of course, we need to remove the structural blocks or constraint in terms of course, irrigation, market infrastructure. There also we have invested, like these farmers markets, that kind of thing. So of course, market side we have not invested that much, as you, I think, practically. And anyway, I am also for this, definitely going for in a big way for this public investment. I think with this, some of the points just I have observed and just leave it. Thank you.
Thank you, sir, for coming to, and attending this online. I know you are not keeping very well and you are traveling, but thank you very much for taking the effort to attend and give your comments. I greatly appreciate that gesture. I mean, I agree with most of the points that you mentioned, but just one or two points I'll mention. Is that one, the growth rates of agricultural commodities, if you look at the NAS numbers, that is value of production numbers,
you will see that there is a difference between that and the index number growth rates, primarily because of a higher weightage given to fruits and vegetables in that methodology. So
Okay.
if you look at agricultural GDP, you will see that fruits and vegetables will get much higher weightage. That is why I try to look at crop-wise numbers, where you see that fruits and vegetables are actually performing better. Maize is performing better, and maize is actually a success story of the last 20 years in India in some sense, followed by millets, followed by pulses. But the negative story is largely coming from cereals. Basically rice, wheat, jowar, etc. That is where the growth rate has really slowed down. And only part of it has been compensated elsewhere. That is the larger story that you can tell. Part of it is compensated by other crops, but not all of it. That is why in the net you get a slightly adverse result over the last 20 to 30 years. Then number one. Number two, I completely agree with the point you made about subsidies and investment, and I do believe that they should not be seen as counterposing with each other as opposites, but they are sides of the same coin. There is a great value in seeing them as two sides of the same coin, because a lot of subsidies also ultimately become investments, and a lot of investments can actually encourage farmers to adopt more inputs and so on. So there is a feedback relationship between subsidies and investment, which we must be aware of. And in that sense, I agree with you that they should not be seen as two opposites. Instead, there's two sides of the same coin. I'm completely in agreement there. But one point, sir, the monetary policy versus fiscal policy on credit, because if you do it through monetary policy, sir, there is no burden on the government. Ultimately, the banks are taking deposits of people and giving it to the farmers. That's a very separate route compared to spending taxpayers' money through the budget for redistribution. Yeah, all research will show, sir, that both have a role to play in this. Fiscal policy has a role to play. Monetary policy has its own role to play in this whole problem. So interest rates play a very important role in generating investment, deciding how much investments will flow where, and so on. But my complaint with the ideology of this liberalization program has been that it has kept monetary policy completely out of the real sector. It does not see a role for monetary policy in economic growth, employment generation. It does not see a role for monetary policy in redistributing assets or income in the economy. That role is singularly given to fiscal policy. That's the problem that I was trying to say. Instead of giving due to both, you basically privilege one and completely ignore the other. That was the criticism that I was trying to raise in my presentation. Uh, Also, you asked whether my growth rate includes dairy products. I want to say no. I did not use allied sectors in the growth rate calculation. I was primarily using crop sector only in my calculations. Just very briefly, sir, but thank you very much for your comments, and I agree largely with you, but just one or two clarifications I thought I'll make. Thank you.
Okay, thank you, Ramkumar, very much. And I wish you are leaving tonight, or what is your plan?
Yeah, I'm leaving tonight, sir, but I hope to come back again and see you soon.
Yeah, we will meet next time when you come.
Sure, sure,
Definitely. Thank you very much.
Thank you.
So this is the end of any event like endowment lecture. So I am standing before you to deliver a formal vote of thanks. So first of all, I thank our Vice Chancellor for arranging this type of interaction between the students, TNU students and outside experts, so that they imbibe the views of others. So that will not lead to, we call inbreeding. So what we learn, we teach here, but a person like him learned from other side, and he is giving his views. First, I thank our Vice Chancellor for that. Madam is expected to join this lecture, but because of her pre-commitment, she could not do. So anyhow, I thank you, madam. Next, our Dean SPGS. So this is one forum where, as I told, that is the way we enrich our PG students and scholars in their domain and their knowledge in their specialization. So I thank the Dean SPGS, and he has also contributed funds and money to run this show. And for that, again, I am very grateful to our Dean. Next, I thank our Director Cots, who is also very much, he will not leave any opportunity in the university for the benefit of the students. So this, he clinched this opportunity where we have to enrich our students with this type of knowledge. And he has also pinpointed our speaker. So that's also I am very thankful, sir. And I am also thanking you for your presence and gracing the occasion. And next, I thank the speaker. From the biodata given by the director and the actual biodata I have seen, there is a lot of difference. And he is a columnist, we call. So he's go on writing. So we advise you to read. But he read and again he reproduced something out of that. So that's very great. Right. Whether it is right or wrong, you write. So many things he argued against my teachings. Thanks for sir. So students are very much enlightened, and thank you very much for sir. And then I will be failing in my duty if I don't thank our mentor, Dr. C. Ramaswamy, former Vice Chancellor. He is also supporting us in all these kind of activities where particularly students are involved, and he himself posts his ideas, whether in support of the speaker or against the speaker. And he's all along he was talking about the supply elasticity, demand and supply. So whatever time we see, whatever changes the economy is facing, these are the two buzzwords, demand and supply. So he has nicely pointed out, and he has also given his views of this age with his experience. And again, I thank the participants outside this hall, like professors outside, like Dr. R. Salvadivison, he is also given his views, and other participants, economists and other scientists of TNU who has joined in this endowment lecture. And I thank the students who is very interested in learning this type of and attending this type of endowment lectures. So this we wanted to make it as general as possible, the topic. So this policy, everybody will talk. When I talk with the speaker, he's saying he's working in development economics field. So yes, development economics, it's not only economics. So it is a mixture and combination of several domain that is interested or working towards development. So the students who may be not economics, specialized in economics, other also get benefit out of that. So I thank all the students who participate here in person as well as online. I thank the students, and I thank the organizer, Dr. Kritika, who is also very much interested in doing such events, and all my colleagues in the department. I thank them profusely, and again I thank again those who have joined this endowment lecture online. So this is also as per the instruction from the director. So this must be made open to all who is working throughout the state. So I think all of you enjoyed this, and I thank you all once again for joining us and making this event very great one. Thank you all.
Yes, sir.
So if those who are interested in getting the materials that he has delivered, so we are ready to share with you. Maybe not now, after a few days or few time. Okay. Thank you very much.